Temperament is the most important characteristic a good investor can have. Hi, my name is Gary Mishers. I'm the managing partner and chief investment officer at Silvering Value Partners. I also teach the value investing seminar at the FW Olin Graduate School of Business. So why is temperament so important? And I would argue it's more important than a whole host of other characteristics such as intelligence or even, hard work or even education or experience. Those things are important, but at least to a degree in investing. But temperament, I think, is the number one quality, and I think worst of all, to some degree, some you either have it or you don't. Now, I don't want to kind of make it sound like you can't improve it. You probably can, and I think you do have things you can do that can make you better at staying even keel and following your process and all of that stuff that follows from a good temperament. But I think it's hard to move too much from where you start in terms of temperament. So, temperament basically is this. It's you want to basically have the ability to stay within your process, no matter how unsuccessful the outcomes are in the short term. Now, why do I say that? Well, the reason is in investing, the feedback loop is really long, right? So think about some other activity like hammering in a nail. So if you take a hammer, pretend I have a hammer over here, and you're hammering in a nail and you hit and you miss and you hit your finger, that's gonna really hurt. Like ouch, right? You're gonna have a very short feedback loop and you're going to know right away that what you're doing, your process is off. And you're gonna either learn or maybe you're gonna hire someone else to do your hammering for you, but either way, you're going to adjust. In investing, it frequently takes years to find out if you're right, and it takes many years to find out if you're a good investor in terms of just looking at the outcome, right? So if you are using short-term feedback from the market, other investors, stock prices in general, all those things are essentially the same thing, you are going to get the wrong message because you might very well be doing the right things process-wise that will lead to your long-term success, but in the short term, it might not be working out the way you want. And now let me take a quick detour and think about our ancient ancestors, back in savannah or somewhere far away, the prehistoric humans, right? We were tribal creatures, right? We succeeded as a species because we lived in groups and we were better than other animals in groups. Okay, so what does that mean? Is that we have this very ingrained sense of fear of the disapproval of our tribe, because in that ancient world, if your peers, permanently disapproved of you, they would expel you from the tribe, and you couldn't really survive on your own for the most part, and you would die a lonely death, and that's not a good thing. So we have this very strong sense of, most of us, at least ingrained in us, in our kind of the reptilian part of our brain, where we are going to care what others think of us in the moment. And so think about the following scenario. You are, following your process wherever it is. Hopefully you have a process, right? As an investor, and whatever it is, you're following it. And then you look at your stock screen or you look at your results, however you look at them, and the results are not very good. Then you say, not a problem. No. Now imagine this scenario persists and it persists and it persists and it persists. At some point, you're going to have this very strong feeling that maybe you're just wrong on your process. That's, by the way, that's not to say that you shouldn't keep evolving your process or you shouldn't, assume that you can make mistakes. We all make mistakes, so we can make a lot of them in investing. But there's a very big difference between searching for process mistakes and just getting this mental fatigue about basically the market or other investors disagreeing with you for a prolonged period of time. And if you're a value investor, and when I say value investor, and I'm not trying to judge other people, there are many successful ways to invest, but if you're the kind of value investor who is not redefining value investing as buying really high expectations growth stocks and saying that they're undervalued, that's a separate discussion. But let's say you're a more traditional value investor where you're buying companies where you're hoping that the past is a reasonable prologue to the future and they don't need to grow very much for this to be a good investment. That hasn't been working out really well lately, for many people. I mean, I'm sure there are individual counterexamples, but as a group, value investors have had a terrible, 1, 3, 5, 10 plus years. I mean, even in some cases, 15 years, right? So you have this very long period of essentially your tribe, disagreeing with you, disapproving of you, disapproving of the outcome of your labor. And that's mentally fatiguing. It's hard. I talk to a lot of friends who are value investors. It's not easy. Nobody likes to go wake up and be told day after day, year after year, oh, you're wrong. Oh, nope, sorry, you're still wrong, right? That's just not how people enjoy spending our time, right? The question then is not whether you enjoy it or whether it's mentally fatiguing or not. It is not enjoyable and it is fatiguing. Like anyone who says that they love it, they're full of it. That just doesn't exist. However, what does exist is the difference in what do you do with that. Now, and there's a whole range of things you can do with that. One extreme, you can essentially, fall apart, start doing completely different things than what you think you're good at, try to kind of change with the times, try to, like a chameleon, when you're on the brown branch, you're brown, on the green branch, you're green, and start to completely change your process. Or just abandon your process and do random stuff, hoping that the pain goes away and finally you strike gold and something that you do works out. On the other side of this continuum is you deviate not at all. You stick to your process, you continue to evolve, you continue to get feedback on things that you could do better process wise, but you don't let the outcome just tell you in the short term or even intermediate term whether that's the process is good. You think about things from first principles and you stay completely 100% rational and unmoved from the way you think things should be done. That's kind of the ideal. I don't know if the ideal is attainable, but I think that there are people who are a lot closer to that ideal than not, and they're few. And I think that that's why that is such an important characteristic and it's so rare, is that most people aren't wired that way. Most people are wired to eventually give in to the fatigue and the negative feedback from the stock market and change. And usually, by the way, when do you think they're going to change? They're going to most likely change right at the moment. It's like the totally worst time to change because this kind of negative feedback loop has been going on and on and on and on. Finally, they say, you know what, throw in the towel, forget it. This value investing thing is just too painful. I am going to find some compounders, pay 50 times earnings because they're worth 80, or 20 times sales because they're worth 30, but they're really powerful, they have big moat, whatever, right? Whatever the narrative people want to tell themselves. That's not to say that that's a wrong way to invest. It's to say that if you're doing this because it's just too painful to stick with your process and you want to buy things that have been working lately, that's what's wrong. It's not that there's not a successful way to invest in growth stocks. It's that if you have a process, presumably you thought it through, it plays to your strengths and it tries to minimize your weaknesses, and you have a good reason for practicing that process and not some other process. So when you capitulate and you change because of the negative feedback of the stock market, you are just, you're making a behavioral mistake, and it's an expensive one. Usually, we've seen this in the past. This happened in the in the late 20s. It happened in the late 60s. It happened in the late 90s. I kind of think that now is one of these other times where you can tell a lot about investors by how they're handling this painful period for many value investors. Anyway, I know this is kind of turned to a stream of consciousness a bit, but temperament trumps a lot of other things, because if you have the right temperament, assuming you have sufficient IQ, which doesn't need to be super high for investing, this is not rocket science, and if you have, a, just a common sense around you, you can build on top of that and be a good investor. But if you have the highest IQ, you went to the best business school, you have years and years of experience, but you just have the wrong temperament, it doesn't matter what your process is on paper because you're going to fall apart, right? And that's just not something we like to think about ourselves, but it's true. And so I think that temperament and knowing how you actually act under duress, because it's easy to stick to your process when it's working and it's giving you positive reinforcement. It's when there's negative kind of reinforcement that it's so important to stick to it. It's temperament that's going to determine very long term, so in terms of decades, how successful you'll be at this. I hope this was helpful to you. If you like the video, please hit like and subscribe to the YouTube channel. Thank you.